Hey there, and thanks for watching. Over the next few minutes, I'd like to discuss the cash-on-cash return metric in real estate analysis. Now, I've seen too many people throwing this metric around as if it's some panacea of real estate underwriting, and the reality is it's not. Sure, it's one metric that tells us something about an investment, but without taking it into consideration together with other metrics such as internal rate of return, net profit, equity multiple, without considering the acquisition price in relation to the disposition price, it really doesn't tell us anything about a deal. Now, to illustrate this point, I'm going to use a case study, a very simple case study. I call it the baseball stadium. And the case goes something like this. Imagine your favorite broker approaches you about this opportunity to acquire a baseball stadium. The asking price is $1.2 million, and the stadium is currently leased to a local minor league baseball team on a 5-year lease at $100,000 a year. Now, you believe that you could go to your local bank, take out a 75% loan-to-cost loan, interest only, $45,000 a year in debt service payments, and therefore invest $300,000 into this deal to make it happen. And so you grab your favorite model and you begin penciling this thing out. $1.2 million in purchase price, $900,000 loan, again $300,000 of invested capital, $100,000 a year in lease payments on a triple net basis, minus your $45,000 debt service gives you $55,000 in before tax operating cash flow that the property is throwing off every year. You divide that by your capital invested to date, and you get your cash on cash return in each of your analysis years. Now, at first blush, this looks like a pretty good deal, right? If we look at the average cash on cash return per year, 18.33% a year. And you go, wow, if this was the only metric you used, this is a deal that you'd do. Now, as you start doing your due diligence, you discover that the baseball team that's currently leasing the stadium has agreed to sign a new lease 5 years from now with a new, bigger stadium. Therefore, they're leaving. And in understanding the market, you realize that there are no other baseball teams to take the place of this minor league team. And therefore, to really have any value at the end of your analysis period, you'll need to scrape the building, tear the building down, and sell the land. And you conclude that scraping the building would cost $100,000 and that the land would be worth $1 million at the end of your 5-year analysis period. So the question is it worth an 18.33% cash on cash return to do this deal? Well, let's calculate the internal rate of return. Now, the IRR is based on our net levered cash flow line, right? So in time 0, we have $300,000 of outflows. Then we get $55,000 of inflows each year. In year 5, we pay off the loan, $900,000. We also pay a $45,000 debt service payment. We receive $100,000 in operating income. We spend $100,000 to tear the building down, and then we sell the land for $1 million. We net, again, $55,000 in cash flow in that year. When we calculate the IRR, what's the return? Negative 2.83%. What's the net profit? Negative 25,000. And so if cash on cash return was the only metric we used, we'd do this deal and lose money. And so why is this the case? Well, cash on cash return is an operating cash flow metric. It tells you how much cash flow a property produces, but it doesn't tell you anything about the profitability of the deal. The profitability is determined by what you pay for it and what you can sell it for, the value of that asset at the end of your analysis period. Now, I have a more expansive blog post that goes in depth on when the cash on cash return metric is helpful, when it's not. I'll link to that post in the description below. I also have this file as just a quick download, quick free download in that blog post as well. Go check it out. If you have any questions, feel free to reach out. Again, my contact info in the description below. Otherwise, thanks for your time today.